Hey everybody, and welcome to this week's Nasdaq Dorsey Wright podcast. This is being recorded on Thursday, April 14th, 2022. My name is Will Gibson, and I'm joined this week by Jamie West. Last week, if you caught our podcast, Ian and I talked about some of the major performance trends that we saw in the first quarter of 2022. Mainly, again, just from a headline performance-wise, talked about asset classes, talked a lot about commodity, fixed income performance, some of the trends within the equity market. And this week, Jamie and I are going to have a more focused conversation about how active management and passive management did in the first quarter of this year. As we were just talking before we got on the call, it's, I think, a pretty popular topic right now, especially because passive management has been so dominant for the past 8-10 years, probably so. And even the sector composition of indexes, you can see how that's contributed to that. And a lot of the rhetoric is that in these type of market environments where you get these tumultuous periods where you get small sectors outperforming energy, basic materials, and whatnot, it tends to maybe help active or make a case for active. So we're going to unpack a little bit of that today, and then mention, of course, on the fixed income side and some international as well. And this will be in our report today as well. And Jamie's putting that piece together. So maybe, Jamie, what are your thoughts, just kind of high level on the report, active versus passive, some of the core tenets of those?
I think you kind of nailed it on the head. At least in the U.S. large cap space, which is, what gets a lot of the focus, it's been a very difficult environment for active managers over the last 10, 15 years. And that has really, got a lot of people questioning, should we be using active management at all? You can clearly save clients a lot of fees by going passive. But, people who are proponents of active management always say, well, wait till, the next down market, wait till volatility picks up. Those managers that are in there picking quality, they're going to outperform. So when we get a quarter like we did, that just ended, it's interesting to see, okay, how did active managers actually fare during that quarter? Were they able to kind of maneuver through the volatility better than the passive indexes? And in this case, in the large cap space, active managers fared a little bit better than they had. The benchmark finished around the 50th percentile last quarter. Typically we've seen the S&P 500, if you rank it against all large cap managers, quite often finish in that second quartile. So, above the 50th percentile, sometimes above the 75th percentile, meaning that if you pick an active manager at random, you have about, your odds of outperforming are less than 50%. So in this case, active managers, about half of them outperform the benchmark. So they did do a little bit better on a relative basis, but you still had only about a 50-50 chance of outperforming with a randomly selected active manager. So not a really strong case for them in this quarter.
Yeah, that was surprising. I was definitely expecting it to be a bit higher than it was, to be honest. And the quartiles that we're talking about here, we'll put the images in the YouTube video, and then we'll also put them in our report today that you can see them. You got your green box at the top of the top 25%. That lighter green is going to be your 50 to 75, and et cetera down. So as Jamie mentioned, that kind of 5-year trend of that large cap equity space, the S&P 500, your benchmark has been comfortably in that second quartile. Even some years you've seen it push closer to that top quartile, and then this year just kind of in the middle of the pack. So maybe the rest of the year this tends to move a bit better if maybe if energy keeps going, basic materials keep going, utility staples, areas that we've talked about being strong. Those are all small weights in at least the S&P 500 and maybe the large cap space as a whole. So maybe if that persists, it'll help active a bit, but maybe not to reverse a long-term trend.
Well, and, I think, you kind of touched on another interesting point there, and that is there may be some fear among these managers of moving too far away from the benchmark. I think energy is 3-4% of the S&P 500. Even if you have a really strong belief that it's going to do well, they may be hesitant to go a 10% weight on energy, because if it doesn't go their way, they're really going to underperform. And so I think there is some there's a tendency in these active managers to kind of hew kind of close to the benchmark in terms of sector allocation. So that may be some of the reason that even when, the market from last year kind of gets flipped on its head, technology is getting killed, energy is killing it. Yeah. You don't really see a lot of outperformance from these active managers because they may be hewing pretty close to those benchmark weights.
Yeah, that's a good point. Yeah, that is a good point. Probably a lot of that. Moving outside of the large cap space, we also mentioned small cap. So we did the same type of performance analysis, active, kind of passive on the small cap space, Russell 2000. Jamie, any main points that you want to pull up from there?
Not a whole lot from what we've seen. Not a whole lot different from what we've seen when we've looked at this previously. I think it's always kind of important to point out when you kind of hear about the active versus passive debate, especially from people who are big proponents of passive, they really like to focus on U.S. large cap. And that really has been the place where passive has, really dominated. Has been very hard for active managers. But you get into other areas and you can see that, there are long periods where active still outperforms. One of the things that really determines how well active managers do is the level of market efficiency. Do prices in the market reflect information quickly and accurately? And in the U.S. large cap space, these are the most researched stocks in the world. So you start to get away from that universe, and there is room for, skilled managers to, find new information, do a better job valuing the stocks, and kind of add some value. And we can kind of see that in the U.S. small cap space. In the last 2 quarters of 2021, the benchmark finished in the lowest quartile. Kind of surprisingly, it actually finished near the 50th percentile in the first quarter of 2022. So, the volatility of the first quarter not appearing to help active managers or the number of active managers outperform the benchmark. But still, your average small cap manager did beat the benchmark in 2021. Yeah. I'm sorry, in 2022.
Yeah.
In the first quarter.
Yeah, first quarter of this year as well. And even from a longer term perspective, to your point about some of those macro reasons that you see active management fare a bit better in small cap space, market efficiency certainly being one of them. Earlier mentioned today, just a broader basket of funds to be selecting from. And then another one, if you look at this trend, you typically see your passive benchmark near halfway or if not lower on the benchmark, on those performance returns. And then an interesting note to your point, not going a bit more. So December of 21, September of 21, you saw that passive benchmark actually in the bottom quartile of the performance returns. And we're talking a bit about why that was. I think you had a pretty good take on that.
Yeah. So active management in small cap had a really tough go of it in the beginning of 2021. You saw, things like GameStop, AMC, these things were up hundreds of percent. And they were largely not owned by active managers because they were considered low quality, problems with their balance sheets, things like this. That's why they were so heavily shorted. And you saw the short squeeze action that happened. So active managers really struggled against the benchmark in early 2021. I think some of that reversed later in the year. You saw GameStop come back to earth a little bit. Some of those others that had really,
AMC.
Had really pushed up the benchmark in some cases kind of came back to earth. And I think that's one of the reasons you saw that the index dropped down to that fourth quartile in the last 2 quarters of the year.
Yeah, that makes sense. That makes a lot of sense. And then maybe a last note on small cap active management, where it's also talking about this, where the sector composition of small caps is much different than the large cap space, where large caps are definitely very tech heavy, consumer discretionary heavy, or at least in the past 10 years, 5-10 years, that's been the case. But in small caps, you're seeing some of the sectors that are in favor right now, more overweight in the small cap space, like Energy, I know, is a much larger weight in a lot of small cap passive indexes. What else? Financials, I think, is a pretty decent weight in a lot as well.
Yeah, depending on the particular small cap index you're looking at, yeah, sometimes financials will be the largest portion of that index. Whereas, in large cap, it's clearly technology, by a pretty good margin. So, I think energy definitely has more of a presence in the small cap space, just from a relative weight perspective, which is probably kind of helping the passive benchmark in this case stay near that 50th percentile, as it just has more exposure to energy, which has been one of the strongest areas of the market this year, and had been kind of cast off by a lot of people as, it had been a decade that energy had underperformed almost every year.
Yeah, for sure. Okay, maybe moving outside of domestic equities now. I think we're ready to roll out internationally, at least. So outside large, small cap, domestic, we also looked at this for emerging and developed markets. Either of those, I think we could start talking about here. Also, some pretty interesting, maybe starting on the emerging side, a lot of kind of academic stuff there we'll talk about as well, market efficiency and the research available for companies that are traded on overseas markets or less publicly available information, at least.
Sure.
Again, on that point there. And maybe you kind of see that from the long-term wise, but over the past quarter, did that hold or what did that look?
No, kind of interestingly, in like international developed, even over the last 4 quarters, we see the benchmark ranking in, the second quartile, pretty consistently. And that's, in a contradiction to what we've seen over longer term. The last time we looked at the rolling 5-year rankings, you saw the EFA index, in the bottom 2 quartiles, I think across every time period. So to see it, for 4 straight quarters ranking, in the top 2 quartiles, that's definitely kind of a change of pace. Definitely the possibility that, all of the geopolitical shifts that have gone on have really kind of worked against active managers, as they, weren't able to anticipate some of the things that have happened. Russia, Ukraine, some of those sorts of things, that don't necessarily fit in with traditional financial research. And that may have really helped the benchmark to, reach the top quartiles as it has. I also say, obviously, there has been quite a bit of currency movement. The dollar has been on a tear, which is a headwind for U.S. investors investing internationally, but all of those currency movements also could, play a role here. And then also just a lot of different actions from different central banks. We have the U.S. and most of Europe pulling back on stimulus, trying to tighten monetary policy. You have China, who is now talking about adding stimulus to their economy. So just a lot of different factors kind of moving in and out of the international space.
Yeah, probably a bit more sensitive than the domestic markets are to some of those things, for sure, especially like currencies like the dollar. You mentioned some of the geopolitical risk. Those companies within these indexes probably move much more related to that. Where you look at relations to crude oil or relations to resources, especially on the, I think, emerging market side, you see that too, frontier markets and the like. And I think we were talking about before on the emerging side, China was playing a really big role in the performance of that passive benchmark. But as of late, active management, I lost my page here. It's done a bit better lately. It looks like, at least this quarter.
Yeah, over the last, at least in the last quarter, the EM index sits right around the 50th percentile. And this has been something that we've seen recently. The last time we did like the rolling 5-year rankings, you saw EM in the second quartile a couple of times, maybe 3 or 4 times out of the last, 5-year rolling rankings. So not too unusual, but perhaps kind of unusual because, as we said at the beginning, we do kind of expect the active managers to outperform in down markets, or at least that's the thesis. And that has not played out this time. We can see that the MSCI emerging markets benchmark down almost 7% last quarter, but still ranking near the 50th percentile, meaning that half of active managers in the space lost more than that. So what's the ultimate cause of the strength of the passive benchmark last quarter? I'm not sure that there's a good answer for that. Again, it could be that active managers just weren't able to predict how some of these geopolitical situations were going to play out. It seems like countries actually did better based on their geography to the Russia-Ukraine conflict. So managers who were concentrated in European countries near that may have done poorly just because of the geographic location of how their portfolio was geographically allocated.
That makes sense. Cool. Well, maybe the last segment that we'll talk about today, maybe the easiest segment to talk about, like fixed income, had an absolute bloodbath the first quarter of this year. I think it was like worst start to a year ever. I think worst drawdown ever I've seen as well. And if you were to put it on a spectrum, probably large cap equities down here being active management, and then up here would probably be fixed income in terms of the ability for active management to outperform your benchmark, mainly because of the benchmark, the ag itself. So if you look at any real long-term comparison between active and passive management and fixed income space, it tends to favor active managers more often than not. You typically see that passive benchmark in the bottom 2 quartiles more often than not. And this year was much of the same from what I've seen so far.
Yeah, I think if there's a space where you can definitely say that active managers are adding value, it's definitely fixed income. You can see in the current quarter or the most recent quarter, the ag was, as you said, down almost 6%, finished in the third quartile, which was actually a pretty good finish for the index. Over the longer term, we've seen it finish in the fourth quartile a lot, meaning, you have more than 75% of the managers outperforming the index. A lot of reasons for that. Active managers in fixed income can kind of take on a little bit more credit risk to get a little bit more yield to kind of boost their returns over the benchmark. So there are, kind of a lot of ways for them to kind of maneuver their portfolios to kind of beat that benchmark. And, I think as you mentioned earlier, the ag index is now 40% treasuries. So not a lot of selection to do there. You're not really comparing credit quality when, half of the benchmark is, at least considered to be risk-free debt. So just by doing a little bit of, relative value analysis, taking on a little bit of credit risk, it doesn't seem to be too tough for those managers to beat their benchmark.
Yeah. And not to call it a straw man benchmark, but I think there's probably some of that going on there, where over the time, as you said, the composition of the ag now is much more conducive to active management to outperform, it seems.
Yeah, I think, we've talked a couple of times about just how the differences between equity benchmarks and fixed income benchmarks. One of the big ones, when you see a cap weighted equity benchmark, the companies in it, they are at least the most successful companies in terms of increasing their market cap. Fixed income indices are often weighted in a similar fashion, but that doesn't necessarily relate to those companies' size. It's just how much debt they've issued. So while you're getting some of the most successful companies, at least in terms of increasing their equity value in those equity benchmarks, in a fixed income benchmark, you're getting perhaps just the most debt laden, which, as we know, are not always the most successful companies.
Yeah, definitely. And that actually made me think of a point that I wanted to make earlier on the large cap space, where the S&P 500, that cap weighted benchmark, employs a lot of momentum inherently, which could, one, highlight why the factor is robust, but also why that benchmark is really tough to beat. Is because, as you said, market cap weighted, prices going up, it's getting a bigger say in the performance and dictation of that benchmark. So momentum kind of inherently inlaid in that large cap space. So whether we do momentum here, kind of fighting fire with fire there, or elsewhere, try and use other factors to beat that benchmark, that probably speaks to why it's tough sometimes, at least on the equity side.
Sure. Yeah. I mean, I think you're exactly right. Theoretically, at least, the S&P 500 should be the 500 largest companies on the U.S. market. It works out a little bit differently, but I mean, that means that, almost like a relative strength matrix, if you drop below that 500 mark, you're getting kicked out and something else is getting brought in. So there is, I'd call it a slower moving momentum, but definitely
some type of tilt or bias towards that factor.
Yes. Yeah.
Yeah. Well, cool. That's, I think, the main stuff that we wanted to hit on today. Anything else on the mind?
No, I think, overall, did not see the outperformance from active management in the first quarter that we might have expected to see. Within the small cap fixed income space and international, I think there's still a strong case to be made for active managers. In the large cap space, remains to be seen, but the case that a down market's going to favor active management doesn't really seem to have played out this time.
Yeah. So maybe the rest of the year will help or hurt that thesis. I'm sure a lot of active managers are going to rely on the rest of the year to help their thesis for that. Maybe start of a new trend. Who knows? But that was good. Thanks for coming on to talk about these. We'll try to update these every quarter on the podcast to bring that up here and keep track of that. So thank you for all those who made it to this point in the podcast. Thanks for listening. Per usual, if you have any questions, don't hesitate to reach out. Thank you.